Hello and welcome to this special Policy Watch edition looking at the key financial market expectations and economy outlook for 2016. We've had a difficult 2015 in both the markets and economy. Difficult because expectations were higher than what actually happened. In relative terms though, India has done well among emerging markets and is facing many pressures because of reasons like a weak global economy and a strong dollar which are beyond its control. Now, India is also a beneficiary of lower commodity prices, as are many industries and companies. The questions for 2016 are simple. What are the possible headwinds and tailwinds the economy could face? What are the industries and businesses that could do well? And more importantly, how do we prepare for the worst and equally the best in 2016? Joining me to discuss this are Navneet Punot, Chief Investment Officer of SBI Mutual Fund, Atul Joshi, Managing Director of India Ratings, and Pankaj Sharma, Executive Director of Equirus Securities. Thank you very much for joining me. So, Navneet, let's begin with and try and lay down the foundation for what happened in 2015. And let me ask you first about stocks.
On the stock market, I think amidst an extremely challenging global environment, India has relatively done well.
Okay.
We have to see in the context of what has happened to most of the other emerging markets, where currencies, where the bond market, where the equity markets all got submerged. I think in this backdrop, India relatively remained, I would say, not say insulated, but I think has relatively done well. And one of the interesting feature of this year is return of domestic investors. After a long time of 5 or 6 years, we have seen the large number of domestic investors coming back to the market.
And
overall markets have, and through mutual funds particularly. The markets haven't delivered great returns. By and large, mutual funds have done well, but the overall at the index level, the market hasn't done that well. Maybe some of the gains got front loaded last year, but I would expect that as the corporate profitability revised from this quarter onwards, I think good times are ahead.
So, I'll do the contextual question in a bit, but if you were to look at India, absolutely. I mean, when we had a new government, there was expectations, the markets went up. We seem to have lost most of those gains.
No, not really. So, I think the macro has improved considerably. The government's effort, whether on economic diplomacy as reflected in the FDI or some of the other measures that have been taken, are bearing fruits. But we had certain challenges. So, if you look at 2 or 3 balance sheets that were under strain, so real estate sector, corporate sector and the banking sector balance sheets, they had strain. But an extremely challenging global environment, exporting your way out is very tough. And then you had some of the rural distress because of the lower MSP hike, the impact of the drought, the less government spending and all that. So, rural spending has got impacted. And together of all this, we are not seeing the profitability growth that people expected some time back. Also, a large part of the corporate profits are also dependent on what's happening globally. So, when commodity prices are lower, commodity companies are showing a big drain on their profitability, and same thing with some of the other exporters. Put together all this, we have seen the stress on the corporate profitability, but I think we are very,
so, you're saying that all this
bottom.
reflects a fundamental resilience which we perhaps even didn't expect.
Absolutely.
Okay, good point. Atul? Just to sort of lay out what happened in 2015 before we go to 2016.
So, on the macro side, I think we've done a good job. I think 3.9 will be achieved in terms of the fiscal deficit. We'll be able to maintain.
Did we do a good job because we planned it so, or is it just
both the sides? I think we've done a good job on the revenue side, which is our biggest weakness. If you ask me, what is the single biggest factor that this government needs to focus on, is to increase our revenue to GDP ratio.
Okay.
People talk about tax to GDP, but I think revenue to GDP, we are at about 21%. And the BBB median in which our country is rated, it's about 33%. So, we are substantially lower on that piece. We've done a little bit of improvement there. We need to do much better than that, but 3.9% would be achieved. The second good thing is that the government has front loaded the capital expenditure, now 60% higher than the last year. Of course, there are fine prints that the most of the expenditure has happened only in roads. The other 2 sectors where they had promised, which was the rural development and railways, virtually there is no incremental expenditure compared to last year. The third thing is debt to GDP. I think we'll continue to do a good job of.
Is that also because, I mean, you mentioned railways, is it because the government wants to depend on borrowing from the market for that, or?
I think the plan is there, but the execution is where yet to come.
Okay.
It's happening in bits and pieces. Debt to GDP, I think again 65% will maintain it for the next couple of years, which is a good sign. Overall, if you ask me, I think the government has done a good job on maintaining the macro parameters. In terms of, let's say, the banking sector, there needs to be a lot of rethinking. I personally believe that the government's decision to give only 70,000 crores, giving independence to the bank's board of directors, giving them a term. So I think those are the factors which the government really needs to rethink on certain things which they have decided
and there is
already.
a plan, there is Indradhanush, but you're saying it's perhaps not rolling out as fast
Also,
as it.
fundamentally, some of these things need to be questioned. 70,000 crores versus a requirement of 1,70,000 crores is nothing.
Okay.
There's no backup plan if the tier 2 and,
And we're asking about banks because they are the sort of underpinning of the entire macroeconomic fundamental.
Sure,
which
and
will
it will
lead
have
to-
an impact on the budget.
Correct.
It will
Correct.
have an impact on the budget,
Correct.
which is not the case.
Correct.
right
Okay,
now.
Pankaj, one is to look from above, and let's look from below. So, what are the things that you saw floating up or surfacing, as they say?
See, I think if you look at something which Navneet just said, that of course market is not doing too badly, because if you look at two data points, I don't know when it has happened earlier, but the IPO market has remained buoyant. Secondly, if you look at some of these mid-cap names, they have done relatively well. So if you look at in that context, I think headline market performance might not look that great, but still there are people interested in the market. So it's ultimately a market where you can't really ride the wave that if you buy something and it will outperform. That's not going to be the case. You have to do your homework well, and then if you find the opportunities, I think it's still in a market which is
So,
very
the mid caps that you talked about, so why did they do well? I mean, were there any common factors behind their better performance?
No, there is nothing common, because if you look at many of these stocks were doing relatively better. So let's say if you look at, I'll give you an example. Let's say if you talk about L&T, L&T is a company which is very much exposed to the overall macro environment, and if the capex story is not reviving, L&T is unlikely to do well. So there is nothing wrong with L&T and there is nothing wrong with the company, but because the macro environment remains bad, the capex revival is not happening, L&T will not do well. But in selective pockets, let's say roads have started to do well. So there would be company like Ashoka Buildcon, Sadbhav, even PNC. These are the companies which are mid cap and they are benefiting from the activity which is happening in that space.
Right.
So you have to really look at the sectors which have started to do well, and if you take examples of companies from those sectors, I think it's still a good thing.
Right. So, Navneet, I mean, if you were to now look a little ahead, I mean, we'll do a 2016 projection in a while, but how are these little stories adding up as we stand today at the end of the year?
So one of the things that we have been a very big beneficiary of the fall in commodity prices globally. In one sense that has that has improved our macros, so whether the subsidy bill, the fiscal deficit, inflation, current account, everything got improved. Of course, it impacted the profitability of some of the commodity company. But I think that commodity prices are very close to bottoming out in general. I think most of them are near the cost curve. Some of them are at lowest point in last 10, 15, 20 years at the record lowest level. And then when commodity prices go up, and next year even the food inflation, I think we have also been benefiting from the decline in the global food prices. And I think if that reverses next year, one of the challenge for us, how to ensure that the consumer price inflation doesn't go above 4 or 5%. There I think both the supply side reforms and RBI will have to remain on the vigil. And I think if we are able to continue on the path of the 4 or 5% inflation, then the overall macroeconomic stability could be at a completely different level compared to what we have seen in several boom and bust cycles in India going backwards.
So you're saying also that the markets, I mean, we discussed this, have relatively been resilient considering what it could have been had India done worse than it did, or not as well as it did.
Yeah, and also we have to see that the overall liquidity environment has been extraordinarily supportive. So you had right from US Federal Reserve to European Central Bank to Bank of Japan to PBOC to Bank of England, everybody has been very accommodative with the low inflation. But next year, as you see the divergence in the monetary policy where the US Federal Reserve start raising rates, that will also impact the global markets, and we have to be cognizant of that fact as well.
Okay, so let's talk about flows for a second. You talked about how this has been a unique year because we've seen mutual funds benefiting from investor interest and at a level which we've not seen in a long time. So is this secular?
I think the domestic money flow is a secular thing. The equity ownership is abysmally low within the overall households. I think if you put a couple of things together, the whole government's focus on the financial inclusion plan, the payment banks, the direct benefit transfer, I think a real estate regulator which is going to come up, the gold monetization, all these things put together can have certain 2 or 3 large impact. Number one, over a period of time, the parallel economy becomes more and more mainstream. The tax to GDP ratio goes up, government's ability to spend more money. But another larger impact could be an increase in India's savings rate, and within those savings, a larger proportion comes to the financial savings. So the flow to equity market and the long-term bond market from the household balance sheet, which is one of the strongest balance sheet in India as of now, this is, I think, to a very, very secular trend going forward.
Right. So Atul, this is also the year where we've concretely created a gold monetization scheme. We're trying to, create as physical and sort of, more active assets for those who hold gold. So do you see shifts in the financial market composition, maybe going towards financial savings, as he says?
To some extent, yes. Definitely, given the commodity prices, the people have taken a beating, investors have taken a big beating, those who are very bullish on it, given the past trends. So I think definitely there would be a shift away from gold, away from real estate. And what is required actually right now at the moment is a way out of the locked amount. So, those who have bought gold at 40, would they be willing to sell at 25,000? Those who have invested in real estate at, let's say, 5,000 rupees a square foot, will they be willing to get out at 3,000 rupees a square foot? So same thing, where is the unlocking mechanism? Where is the avenue? And we are not seeing that kind of, let's say, returns inflation in any of the other assets, whether it is financial markets or equity market or anything else, where I think the incentive for the investor is that I disinvest in a loss-making investment, but get into an investment which is substantially higher and can,
So what will trigger that?
To be honest, it's the mindset is one, but I think we are, as a nation, denying the fact that we've turned around.
Okay.
Everybody, whenever and whoever you speak to, is basically denying that our capital formation is substantially higher than what it was 3 years back. Our actual, if you see the PFCE, the private final consumption expenditure, it's almost 3 times than where it was in 2013. Consumer durables, consumer non-durables, capital goods, we are simply denying every single positive data. We are saying nothing is happening. I think we need to get out of that kind of mindset. I think it would take another 2 quarters, maybe July next year, the numbers would speak so strongly that it will not be possible for someone to say that, nothing's happening on the ground.
Okay.
And that's the time when, we would move on.
Okay, right. So we'll see where we'll move on to in a moment. So Pankaj, are you seeing, you mentioned a few companies, you said they're the beneficiaries of increased capital expenditure, particularly in areas like infrastructure, roads. Are you seeing other examples like that, which are in some ways benefiting from the changes that
I think there are examples, like, again, because infrastructure is such a critical sector here. It's a sector where you would see that if the gas availability becomes better, it is good. And we are already seeing examples like Torrent Power. Similarly, if you look at if the GST goes through, companies which would have market share moving from unorganized to organized, like a big beneficiary could be Symphony, which is in air coolers. So you would see these kind of examples where the shift is happening and the companies are getting benefit of that. And one of the points which was highlighted earlier, that as the parallel economy becomes more and more mainstream, and I think GST could be one reason for that, it would be a big factor. And I think those kind of things would be there, and those kind of trends would be there, and we would see, of course, 1 year is a very small time frame in nation's history, but we would see these kind of trends emerging in next 3-4 years, and I think that would be very, very positive.
Okay, so you did mention GST. So Navneet, is that, to what extent are we betting on GST?
I think it's one of the significant reform. For a long time, we have all been waiting for that to make India one market.
So that's why my question was, why are we
if it doesn't
betting?
happen, I think it's going to impact sentiments, but I think, we will deal with it. I think what may happen is that in case it doesn't get passed, my sense is that I think government would be under tremendous pressure to make sure that there are a lot of other executive actions which can make up for the loss that you have because of the delay in the GST. And I think we are going to see a many more other actions from the executive side to compensate.
And we'll talk about what.
But I'm still hopeful that it goes through
in 2016. Okay, so we'll talk about what the other executive actions could be as well. Atul, I know there was this entire year went with everyone pitching their hopes on GST and that being a major reform step. Do you feel that this could upset our sort of budgets and accounting, or the way we've been thinking of what our economy could be?
I think it's good to have, but it's not something which the
because
nation hinges on.
Yeah.
So I think we've spoken too much about it. We have given too much of importance and created an image that without GST, this country is going to come to crumbles. Between 2004 and 2008, nobody talked about GST to reach 9%. So, if I look at the old series equivalent, maybe we are at 6.5%, and old series we reached 9.5% without GST. So why is it a precondition for me to achieve 9% growth again? I think it's good to have, again, just to repeat.
Okay.
Yeah.
Okay, great. So let's take a break here, but I want to come back and now really talk about 2016 and what you gentlemen are putting out there for all of us to see. Stay with us. You're with Policy Watch on this special edition looking ahead at 2016. Welcome back here with Policy Watch in this special edition looking ahead at 2016. Navneet, so let's, when we, earlier we spoke, we talked about the foundation, right? What went right in 2015, what went wrong, a lot of things seem to have gone right for India. So if we were to look ahead now, what are we carrying forward in terms of the fundamental strengths and perhaps weaknesses?
I think also the base effect, why we have seen the IIP coming at 9.8% because the last year's base was weak. And I think we are going to see that in corporate profitability next year. On the base that we have this year, next year, I think things will start looking up. The government spending.
But how do the markets view that?
I think markets are expecting maybe we'll have 14-15% normalized growth from next year onwards, and I'm quite hopeful of that. I think as the government spending picks up, there are right intentions. Things have started moving, let's say in the road sector, not as much in railways, despite a lot of work by the government. The actual money flow that we will start from next year, the power, T&D, the defense, some of the other areas, when the public capex, and that will be followed by private capex, but that will take some time. The urban consumption is showing signs of revival. So let's say if you look at petrol consumption, car sales, two-wheeler sales, you look at some of the other parameters, air traffic, they're all showing signs that there is a revival in the urban consumption. I think from next year onwards, with some government spending and maybe a better crop next year, we may have rural consumption reviving. So then you have both the engines working. You have some investment cycle driven by the government spending and the private consumption. Then later on, that feeds into the private capex at a later stage. That's my hope from the 2015.
Okay.
And I think from a global environment perspective, I think India will still remain one of the oases of hope in a world which is still quite growth starved, quite yield hungry. And I think we'll see the interest in the India continuing from both from the FDI's perspective as well as the capital, the portfolio flows.
Right. So Atul, let me take the global part. We have a weak China economy. We have problems in Europe. And many parts of the world, except for perhaps North America, are still looking weak. What's your sense? I mean, to what extent are we likely to be affected by this, or to what extent are the same winds likely to batter us?
So there are two things. I think we've been talking about exports. Now, one of the things that we must look at is that between 2004 and 2010, the global merchant trade was 4.5 times that of the global GDP. From 2011, that has started breaking, and today the multiple stands just at 0.3, which means that there is no way the global trade is going to reflect the growth path of 2004 to 2008 or 2004.
And you can also see it in the
2010.
Baltic Freight Index, which is crashing.
Now, given that, should we really be pushing on exports for our growth? That is one thing which we need to think about. The second thing which we need to think about is that pay a lot more attention to what China is doing rather than what US is doing. I think US is a story which has been chewed too much, and US Fed increase and the currency volatility, I think that's all given. What China has done, I think they're writing a different kind of an economic book, and we are still reading the books written in the US, which was maybe 70, 80 or 100 years back. What have they done with making their currency, which is a pegged currency, an international currency? And how they have taken steps, what steps they have taken, how they have managed the currency volatility. I think that's where we are not focusing at all. I guess the Reserve Bank of India needs to pay equal importance to currency strategy than what they are paying to just the interest rate strategy.
Okay, so that's one thing for 2016.
Yeah.
Now, sticking with China, I mean, China obviously is still slowing down in terms of manufacturing, in terms of how much it's exporting, and its own shift to services. What does that mean for us?
I think clearly, the dumping in the global market will continue. I do not see commodity prices increasing. If at all, they've stabilized. Yes, they may have stabilized, but the increase in the commodity prices is just not going to happen. The third thing is that, the Chinese currency is going to play a much major role in the global cross-currency basket than what we assume it to play. The fourth thing is going to be the capital investments that the China is going to drive. I think the Chinese banks have been given kind of a directive by the central government that they need to go and support Chinese SOEs wherever they acquire natural assets. Now that's something which, over the next 5 to 10 years time frame would ensure that a lot of global natural resources are sitting in China's domain.
Right. So you're saying the lesson for us is we need to accelerate that too. I mean, we are doing that already through ONGC, but
very little. It's just not even a kind of a compared to.
It's a blip right now, but we could surely be accelerating that.
Yeah.
Okay. So Pankaj, how do you pick this up? I mean, so obviously sectors. I mean, iron ore being a classic case where prices have gone to 10-year lows. But how does this sort of translate into markets? Because clearly not everyone is going to do well, or there are more who are going to do badly.
See, I think one thing which is very, very clear that I really don't see the China problems going away in near term. They will remain for some time. Because
and a lot of Indian companies will be affected.
Yes. Yeah. So I think that is definitely the case. Also, of course, we are close to bottom of the commodity cycle, and I don't see any significant major correction from here onwards. So it is kind of stabilizing. But at the same time, it would help a lot of these companies where we would start to see the impact of steps government has taken. So let's say in a couple of quarters, I am very hopeful that we would start to see that in numbers. And that is something which would be very, very good, because ultimately, like if you remember what happened around May 2014, people were hoping that things would start to improve very, very quickly. Earnings would start to come in by January 2015. Unfortunately, that didn't materialize, and I think it was unrealistic hope in a way. So this is something which is not because government has not done anything, not really. Government has taken progressive steps, and I think that couple of quarters down the line we would see earnings momentum coming back, we would see positive earnings, and that is something which is going to help the broader markets. And this is something which is, because if you look at many of these SME kind of companies, they are very, very dependent on what happens on the overall economy. Like if you look at many of these suppliers, which many of these cap goods companies, similarly auto ancillaries for auto, these are the guys who will show benefit, as autos have already started to do well in passenger cars and other areas. So this is something which would help the overall economy, the macro trend.
Right. Okay. So Naveed, looking ahead at 2016, why should investors invest and perhaps come to funds like yours?
So I'm sure that over the next couple of years, we are going to see a structural growth in the economy, as well as a sustained growth in the corporate profitability. Over the last 20 years, corporate profits in India have grown at 14 or 15%. In last 7 years, they've grown at 7 or 8%. I think we are going to mean revert. Over the next couple of years, corporate profits are likely to grow in line with the nominal GDP, which itself looks, I think, more encouraging going forward. And I think the markets are reasonably valued, then investors can expect returns which are in line with the corporate profitability. On top of that, there are several new businesses, new segments, new things that are developing. As you go from a $2 trillion economy to a $4 trillion economy, as you move from $1,500 per capita to $3,000 per capita, this gives birth to several new businesses with the technology that you have got, with the new set of governance that you have got, with the new world that you are in. That will open up opportunities for different kind of stock picking in India. So India is a stock picker's paradise. A good fund manager can deliver better returns than the overall growth in the profitability. Market as a whole should deliver the growth in line with the corporate profitability.
Right. Okay. Atul, so one of your points that you've argued very strongly is that we need to change our mindset. A lot of things, the data according to you is still strong. If we only convince ourselves of this data, then we could do better.
Yeah. So I think we are looking at just the state government, the central government. We have not looked at the state governments. If you just look at the capital expenditure, now 2013, the central government spent about 2 lakh crores. But the state government spent about 3.35 lakh crores. Now this compares just about 2011 when both of them, the central and the state, spent about 1.5 lakh crores each. So today, we just look at the central government's data. If you superimpose the state government data in an aggregate manner, it's almost 70-80% higher than the central government, which means that the growth is not just going to come from what the central government is doing, but what different states are doing in different parts of the industries, whether they're doing it in roads or ports or airports or whichever area. We need to pay attention to that, and then also plot which are the industries which would benefit from that particular capital expenditure, and then plan our
Okay, so let me get a quick wish list. Pankaj, let me begin with you. What's the one thing that you would like to see in 2016? I mean, it could be policy, it could be independent corporate action, or
I think slightly long answer, like what we have seen in last 10 years, that the state governments which have bucked anti-incumbency are the state governments which are leading the states to grow at above average rates. So except for an example of Odisha, you would see Bihar, Gujarat, everybody, they are the states where the growth rate is higher than average. So this trend should continue, because then definitely you would see lot more momentum and lot more political will to do the reforms. And second thing is, I think this whole public capex which government is trying to do, I think this should continue, because all these GST etc. are very important. I am not saying that they are not important, but public capex is something which would help us grow in next couple of years till the time private picks up.
Right. Okay. Atul, one thing that you would like to see?
I would like to have this country evolve a foreign currency or the exchange rate strategy. Where is going to be India's rupee 20, 25, 30 years down the line? If our only philosophy in world is that, you know, we need to depreciate the currency to increase our exports.
Okay.
We need to have a currency strategy.
I
think the administrative
Last
reforms.
word,
Administrative reforms. I know. I mean, the Mr. Suresh Prabhu has got right intentions. Is working very hard, but our ability to really spend money, because there are lots of administrative issues. Same thing with some of the other ministries. I think ease of doing business, if we do, in town for global businesses, global investors, and I think if we put in place the amount of FDI that can come into this country, I think is just unimaginable. So I think administrative reforms is something we need to focus. Legislative, I think one or two here and there, GST, bankruptcy code, it's okay. I think next 5 years.
Yeah, you did say that the alternatives, I mean, if GST done
so I think next 3 or 4 years, focus on administrative reforms, the ease of doing business, judicial reforms. I think they are far more critical than some of the larger legislative issues that we keep talking about. The cooperative federalism has ensured that labor and land nobody talks about, which used to be a big thing till a year back. But then people have realized that state governments can find solutions to that. I think similarly we need to do with several other things.
Right. And the fundamentals when it comes to the economy or parts of the economy and businesses or companies are looking strong.
I think
is what I've concluded from
looking quite strong. Yeah.
Looking quite strong, and will get stronger in 2016.
Absolutely.
Right. That's a good note to end on. Thank you so much. We've run out of time on Policy Watch this week. We'll be back next week, same time. Thanks for watching.